Alright, buckle up, buttercups, and welcome back to Accounting Analytics CPA, the only podcast that makes debits and credits sound cooler than your avocado toast. I'm Chad, and across the digital divide, we've got the queen of the green eye shades, Brenda. What's poppin', B?
Yo, Chad. Ready to dive into some juicy numbers and make sense of the financial jungle for our awesome listeners. Today, we're gonna get down and dirty with financial misreporting and see how it all plays out when companies are in the hot seat facing some serious public health crises, PHCS. We're gonna break it down using the Feynman technique, so even your grandma could probably understand it. No shade to grandmas, they're usually sharper than a tack.
That's right, B. We're not just gonna skim the surface. We're going full-on deep dive, Feynman style. That means we'll explain this stuff like we're talking to a 5-year-old, figure out what we don't know, untangle the naughty bits, and even throw in some slick analogies to make it stick.
So, what's the 411 on financial misreporting? Basically, it's when a company cooks the books, they intentionally mess with the numbers in their financial reports so things look better than they actually are. Think of it like putting a filter on your face pics, but with potentially huge consequences. Now, a public health crisis, PHC, that's when a company's product or service causes illness, injuries, or even death, leading to a massive hit to their reputation. Think contaminated food, faulty medical devices, the kind of stuff that makes headlines and folks lose trust faster than you can say recall.
Exactly. And when these two worlds collide, companies facing a PHC and the temptation to fudge their financials, that's where things get real interesting, and potentially real shady.
Let's paint a picture. Imagine a food company whose popular snack gets linked to a salmonella outbreak. Sales are gonna tank, lawsuits are gonna pile up, and their stock price is gonna do the Macarena downwards. Now, what might management be tempted to do with their financial reports? Well, they might try to manage earnings. This isn't always illegal. Sometimes it's just using the wiggle room in accounting rules, generally accepted accounting principles, GAAP, to make things look a bit rosier. For instance, they might delay recognizing the full extent of the losses or inflate future revenue projections to offset the bad news.
So, it's like they're trying to sweep the elephant under the rug, hoping nobody notices the giant bulge. According to one of our sources, managers in these situations face a real ethical dilemma: be upfront about the financial mess, or try to pretty things up to save face and maybe their jobs. Some argue that GAAP gives them the discretion to show their private information about the future, but others say it's just a recipe for misleading everyone.
Right? It's a slippery slope. Let's dig into a finding from one of the papers. They looked at how companies handle their accruals, which are basically estimates of future income or expenses. They found that companies facing a PHC might boost their income by aggressively managing these accruals. Think of it like saying, yeah, we had a bad quarter, but we're expecting a huge comeback next quarter, so it all evens out. Even if there is no real evidence to back that up.
Okay, so the concept is that when bad stuff hits the fan, PHC, managers might try to make the numbers look better by tweaking these accounting estimates, accruals. But what if someone's new to this? What's an easy way to think about accruals?
Imagine you run a lemonade stand. A customer promises to pay you $10 next week. Even though you haven't actually received the cash, you might record the $10 as revenue now because you've earned it. That's a simple form of an accrual. Now, imagine a company with a PHC. They might aggressively estimate future sales or downplay future liabilities like potential lawsuit costs to make their current financial picture look healthier than it is.
Got it. So, a knowledge gap here might be fully understanding how much discretion managers actually have under GAAP, and when using that discretion crosses a line into misreporting. It's not always black and white, right?
Absolutely. And that's where it gets complex. Simplifying it, it boils down to intent. Are they genuinely trying to provide a fair picture, or are they deliberately trying to mislead stakeholders?
So, for this finding about aggressive accruals, real-world example, think of a pharmaceutical company facing lawsuits after reports of severe side effects from their new drug. They might delay recognizing the full potential costs of these lawsuits, or inflate future sales projections for other drugs in their pipeline to offset the anticipated losses. Practice question: a company in the consumer goods sector experiences a major product recall due to safety concerns. How might they use discretionary accruals to potentially misrepresent their financial performance in the immediate aftermath of the recall? Mental model: picture a pressure cooker. The PHC creates immense pressure on the company's financial performance. Earnings management through aggressive accruals is like turning down the gauge on the pressure cooker to make it seem like things are less volatile than they truly are. Summary: companies facing PHCS might be tempted to aggressively manage their accruals to paint a better financial picture than reality. This involves using the flexibility within accounting rules to potentially inflate income or understate liabilities. The intent behind these actions is a key factor in determining if it constitutes misreporting.
So, fast forward to today. We've got all sorts of fancy tech and more scrutiny, right? How do modern accounting analytics and corporate governance play into this?
You nailed it. Nowadays, there's more emphasis on strong corporate governance, which includes things like an independent board of directors and internal controls designed to prevent misreporting. The idea is that these external and internal checks and balances make it harder for managers to pull a fast one. Also, with advancements in data analytics, we can look for red flags in financial data that might indicate misreporting. For example, spikes in revenue or unusually low expense recognition after a crisis could raise eyebrows.
Right, so it's like having a more sophisticated lie detector for financial statements. But one of our sources mentions that pinning down intentional manipulation is still a huge challenge. You can see weird patterns, but proving it was deliberate is another ball game.
Exactly. And that's where the human element comes in. One study even surveyed executives directly about earnings manipulation practices. While surveys might have their own biases, people might not want to fess up to anything shady. Combining that with analytical techniques can give us a more comprehensive picture.
Let's break down this idea of using data analytics. Real-world example: imagine a company experiences a PHC leading to a massive drop in sales. However, their accounts receivable, money owed to them, doesn't decrease proportionally. This could be a red flag that they're not writing off uncollectible accounts aggressively enough, artificially inflating their assets. Analytics tools can easily spot these kinds of inconsistencies.
Practice question: how can continuous auditing techniques and anomaly detection software help in identifying potential financial misreporting in a company facing a significant public health crisis?
Mental model: think of financial data as a complex network of roads. Analytics tools are like GPS systems that can highlight unusual traffic patterns or dead ends that might indicate someone is trying to hide something or take a detour from the truth.
Summary: modern practices like strong corporate governance and advanced data analytics provide tools to detect potential financial misreporting. However, proving intentional manipulation remains a challenge, highlighting the need for a multifaceted approach that includes both quantitative and qualitative analysis.
So, what happens when companies try to pull the wool over everyone's eyes during a PHC? The consequences can be severe. Their reputation can take a nosedive, leading to a loss of legitimacy among customers, investors, and suppliers. It's like breaking trust. Once it's gone, it's tough to get back. We even saw in one of the papers that companies with higher levels of earnings management after a PHC were more likely to lose major clients and see forced CEO turnover down the line.
Ouch! So, that short-term gain of making the numbers look better can lead to some serious long-term pain, not just for the company, but also for the management team. It's like a boomerang: you throw out misleading info, and it comes right back and hits you in the face.
Precisely. And it's not just about the immediate financial hit from the crisis. The attempt to cover it up through misreporting can create a whole new layer of problems and erode stakeholder confidence even further.
Let's nail down the implications. Real-world example: think of a company that downplayed the severity of a data breach, only for the full extent of the damage to come to light later. The delayed transparency not only angered customers whose data was compromised, but also led to investigations, fines, and a long-lasting negative impact on the company's brand image. What are the potential long-term consequences for a company's stakeholders, for example, investors, customers, Employees, if the company engages in financial misreporting while facing a public health crisis?
Imagine a crack in a dam, the PHC. Instead of fixing it honestly, the company tries to patch it up with flimsy materials, misreporting. Eventually, the pressure will likely cause the dam to burst, leading to far greater damage than if they had addressed the problem openly from the start.
Financial misreporting during a PHC can lead to significant long-term consequences, including damage to reputation and loss of stakeholder trust. This can result in the loss of major clients and even forced management turnover, highlighting that transparency is often the better long-term strategy.
Alright, time to check if you were paying attention, folks. 1. In your own words, how might a company be tempted to cook the books when facing a major public health crisis? 2. What's the main idea behind using accruals to manage earnings during a crisis? 3. Besides just looking at the numbers, what other factors might indicate a company is trying to hide the true financial impact of a PHC? 4. Why might being transparent about a crisis, even if it looks bad in the short term, be better for a company in the long run?
Think you've got the answers locked down? Awesome. If not, give this episode another listen, and remember, understanding this stuff can make you a real financial superhero.
That's all the time we have for today, folks. Thanks for tuning into Accounting Analytics CPA. Catch you next time for more number crunching fun.
Peace out, accountaineers. Like, share and subscribe, and note that we are also on Instagram Accountanalytics. Keep those balance sheets balanced and those ethics sharp.
Like, share and subscribe, and on Instagram. Wow, do you always advertise accounting's analytics?